So before we begin the video proper, let's do a quick poll. Feel free to leave in the comments below on which part of the market cycle do you think we are currently in for the Chinese/Hong Kong market. Are we still in the disbelief phase where we have a good bunch of people sitting on the sidelines thinking that this is a suckers rally? Or do you think there is a renewed optimism around this whole space? Or some of you might even argue that we are already seeing some signs of euphoria or complacency amongst the early investors and we are in for a ride. And I think this is a pretty good exercise to have a rough gauge or feel of the current investor sentiments. I've went onto investing.com to basically sieve out the best performing stock indexes for the year and rank them based on a year-to-date basis. And you can see that the top two markets are actually Korea with the Kospi index and Vietnam with the VN30. On a year-to-date basis, they clocked in nearly 40% year-on-year. And if you actually pay a closer attention, this is a screenshot of the top 18 best performing indexes. 3 actually came from the Chinese market. The Hang Seng at 34% year to date, the Shenzhen at 27%, and the Shanghai at 17%. And the natural question is, hey, where is the US market? So I don't want to do a 1 year comparison and to kind of structure my own narrative to tell you that this is a superior investment vehicle. That's not my point here. But I think just to give you guys a bit more perspective and flavor, at least based on 2025, it is without a shadow of a doubt that the Chinese market has significantly outperformed the US. And this screenshot is a little bit dated. It's on the 8th of August. But you can see that the SPY, which tracks the S&P 500, it's up 9.4% on a total returns profile. China MCHI is at 25% and Hong Kong is at nearly 29%. So it's at a factor of 2 to even 3 times. And I think the common consensus now is that every dog has its day. It's just 9 months. Think about the last 5 years, the Chinese market has underperformed significantly. And if you would allow me to cast your memory back to 2024, in fact, actually, the Chinese market has also outperformed the S&P 500 ETF last year. The total returns for the iShare China ETF was around 28.9%, while the S&P was around 24.9%, significantly outperforming your India, Japan, Europe. So to put things into perspective, I think to be more precise, the bull market in the Chinese equity space has already started in 2024. What if I told you you could get free Nvidia shares just for getting started with investing on Longbridge? So Longbridge, a MAS licensed broker in Singapore, has a promotion running right now. And if you sign up with my link and deposit just 2,000 Singapore dollars, here's what you get. A 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up and you are looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. I've structured this video and titled it based on my own underlying belief and assumption. And clearly, I do have a personal bias. I'm thinking that the current Chinese bull market is one that nobody believes in. And in fact, at the start of this week, there are a lot of economic indicators actually flashing red of the Chinese economy today. From January to August, China's new construction started was actually down 19.5% year on year. Property sales by floor area down 4.7% year on year. Property investment down 12.9% year on year. The August survey for the jobless rate in 31 major cities are currently at 5.3%, and the urban jobless rate actually hit a 6-month high, and 31 city actually rate highest since August last year. And if you showed this set of numbers to any investors 3 years ago, almost no one would believe that the Chinese stock market will undergo a bull run. And in fact, to prove my point, there are many articles starting to surface online telling you that, the China's bull market is forcing investors to finally take notice. Clearly, everyone has already written off the Chinese market, but you're being forced to look at them today. A recent one from Straits Times saying that bubble risks grow as China's stock bull run defies economic angst. And when the market soars, but the economy struggles, China's stock puzzle. And it's clear that investors are both confused and puzzled, hence confuzzled. Now, looking at why investors are forced to look into China today, I think it's quite clear. China's equity rally has been outpacing their global peers for close to 2 years now, and they could potentially be still in its early stages because global investors remains extremely underweight to this group of asset class. And there are a few plausible narratives supporting this upcoming rally, such as progress on the US-China trade talk, easing domestic regulatory risks, stronger currency support, and potentially ideas of fresh stimulus. And I'll share a short clip of what this analyst has to say about the current Chinese market after her recent China trip.
And I think this is an important story about China setting up an alternative AI ecosystem, seeming to do better on the trade front, much better than people had expected back in April, and China feeling more confident about its economic plan moving forward. There's a lot of structural issues I noted, but I think the stock market has been one of the biggest examples of consumer and business confidence bouncing back. Well, I'm a little bit more skeptical about a big bull market happening. I think what struck me, when I talked to investors and even some of the regulators in Beijing is that ultimately the government wants to see a bull market, but what they call a quiet bull market or a slow bull market, meaning that they want to see more upside in equities because they think this is a good sign of China being back in business. It's also a great way to create a positive wealth effect for households that have been really squeezed by the macro slowdown and real estate bubble bursting. And then last but not least, I would say that what has become apparent is that regulators are trying to be as more pro-market and pro-business. That, I think, vibe shift happened late last year in September. The fact that we're starting to see a big shift in the way that the Chinese market is being composed. What I mean is that traditionally, about as much as 90% of daily trading dominated by retail investors, not institutional, whereas, say, in the New York Stock Exchange, that percentage is only 20 to 25% of daily. We're starting to see a shift whereby we're seeing more institutional players coming in. Insurance companies have been allowed to increase their equity exposure to as much as 30% of total assets. And even everyday Chinese people are now, I think, more savvy about investing. Instead of investing in single stocks as they did in the past, they're investing through ETFs on financial platforms offered by, say, Alipay. So we're starting to see, I think, a more intelligent, educated, I would say, capital market system. It's still a long way away from Europe and America, but I think certainly that has been a big shift, and I'm probably not covered well enough in the media.
And on the flip side, however, there are many antitheses that are the prevailing narrative that is plaguing the Chinese stock market or equities market over the past 4 to 5 years. And things include a disconnect from reality. Clearly, China's economy is buckling, yet stocks are extending the historic bull run. There are weak fundamentals from consumption, housing, and even inflation that are flashing red indicators. In fact, it's a deflationary picture in China today. CPI is flat, the PPI is down for 34 straight months. And on a general basis, when we look at the stock market, we always think of companies behind many of these ticker symbols. But funnily enough, as valuations continue to climb, the forward earnings for some of these major indexes, like the CSI 300, is actually down. The expected earnings is down, yet the prices are going up. And this phenomenon is kind of supported by the existing price wars around the companies and also this term called involution, which is incredible amount of competition and the race to the bottom. So with earnings going down, stock prices and valuations going up, clearly there is this very warped view of the Chinese market today. And in fact, a very large argument is that this is currently a liquidity-fueled rally driven by cash-rich investors with much fewer alternatives. There is a huge sum of foreign inflows as well, with overseas capital returning to kind of quote-unquote chase performances. And it's not healthy for the long run. Now, there are also potential bubble warnings, such as Nomura citing irrational exuberance. There are similar parallels that we can draw from history, where China's boom and bust cycle is always built on hype plus leverage. And these factors are fertile soil for capital destruction. Of course, the extremely fragile sentiments, where the Chinese bull market is much more of a mystery box than a conventional growth story. So once sentiments fades, I think investors would flee in no time. And one of the most convincing arguments against this current Chinese bull market is Fugazi money, basically propping up the entire market through leverage through margin. And one of the most recent headlines is comparing today's Chinese market outstanding balance of margin versus the 2015 peak market bubble. And we are already outpacing the current record. But one small nuance to note is that I think due to a myriad of different factors, overall Chinese market has increased from roughly 14 US trillion to 19 US trillion. So even though the current outstanding margin purchase is roughly at $2.5 trillion, the market size in general has increased by roughly 33%. There is still some sort of a 33% margin for error. I'm not too sure about you, but I very much prefer a much more sustainable bull run. And I think one important detail that is also missed out, just looking at the outstanding margin loan, is that within this past 10 years, comparing 2015 to today, the total China deposit rate, basically kind of like a understanding of the balance sheet of the Chinese household today, they've more than doubled as well. So I'm just laying out the facts, and I'm not necessarily drawing any conclusion here. You make your own judgment. Now, looking at the overall Chinese both A and H share market might feel a little bit abstract for most of you, because I believe many of us, especially foreign investors, have a vested interest in probably the H share market, because Hong Kong is a lot more, I guess, foreigner friendly. So I went into the Hong Kong market and again tried to rank all these companies on a year-to-date basis. And you see that we have incredible numbers to show here. So I don't even know some of these companies, but they've basically clocked in 2, 3, 4x just in the last 9 months alone. So you have Coastal Greenland, Investec, Harbin Electric, so on and so forth. So I think to better anchor our understanding, I went into the HSI, which is the Hang Seng Index, and to kind of vet them through their components. And clearly, of course, the top performing company is actually PopMart, clocking in roughly 185% year to date. It has been a global phenomenon. I'll reserve my comments on whether I think it's a bubble or it's a fad, whether I think it's sustainable or not. But just looking at the top 20 names here, we start to see very familiar names like Alibaba, Kuaishou, NetEase, Xiaomi, Tencent, and Baidu. And they've clocked in all more than 50% year to date. 58, 60, 67, 78, and 100% year on year. And of course, it's our beloved Alibaba. But I think one more important thing I wanted to highlight here is that I don't want to be a downer, and I don't want to throw cold water into this party. I know a lot of people are excited of this Hong Kong market rally. We have waited for quite some time now. But I do believe that we are clearly in the second stage of excitement. There's a lot of hope, a lot of optimism. And in fact, in my own X timeline, I've started to see people make, how do I put it, slightly outrageous claims. People are starting to compare Alibaba with Amazon. 377 billion, 2.4 trillion. We are so early in the China trade. I mean, it's totally conceivable that Alibaba is the Amazon of China. But in terms of the total addressable market, whether they're able to reach that kind of scale, the amount of earnings per share and free cash flow that they're able to generate, comparing Alibaba to Amazon, I think that's quite a bit of a stretch. And I honestly don't know whether they are trying to engagement bait on X, but I'm just taking it at face value. And in fact, I think one of the more quote-unquote renowned Alibaba creator on the X platform is this person called Compounding Girl. And he or she actually tweeted out saying that if you missed Baba, have a look at JD and Pinduoduo instead. Probably also suggesting that if you want to exploit the current trade around this whole China momentum, you can look at some of the other laggards that will be pushed up. And I'm not saying that this strategy would not work. In fact, I do believe that there are quite a bit of literature around how the different phases of the bull market, where you see your big or mega cap move first, and then the mid cap, and then the small cap. And once the speculative fever comes in, a lot of all these much smaller cap move a lot faster. They clock in greater returns. And of course, the volatility will also show when the trade goes south. So I think it's more important to be clear of your own investment and trading strategy. And for me to build my case, I think it's only responsible if I can show you my side of the argument and what I think is healthy for the longer run and what I think personally is good investing. So the second largest position in my portfolio currently, Tencent, ticker symbol 0700. I've extracted out the last 10 years in terms of their price action, their earnings per share, and also their free cash flow per share. And you can see that just looking at the stock chart, it has clocked in roughly 4 to 5x from over $100 per share to currently sitting at 645. Even though I know that there is a huge amount of volatility in between. After the 2020-21 crackdown, it crashed from 700 to 200. But if you look at the underlying, what does a healthy company look like? the fundamental growth, EPS on an upward trajectory, free cash flow per share similarly, and the market is really a very intelligent pricing mechanism here. You can see that in this kind of downward trend, free cash flow and earnings per share actually went down. It slightly recovered and then it went down again as they are all trying to price in that so-called reduction in growth. But I think that's it. And the general understanding here is that as EPS continue to climb, as they continue to generate a lot of shareholder return, continue to print greater and greater amount of cash flow and earnings, the stock price should follow. And this to me is a relatively healthy chart. Moving on to Alibaba, I think it's a similar case. I pulled out their EPS, their cash flow from operations, and their total revenue. Albeit, no doubt that there is a great amount of volatility due to their investment capex cycle. Right now, I think free cash flow is probably going to evaporate because they're investing into the next frontier of AI and cloud. But if to draw a very simple line here, from start to end, EPS, cash flow from operations, everything should still be increasing. And that is probably a sign that this is a relatively healthy company with some sort of a growth trend that enables them to accrue some bottom line earnings, which can then benefit the shareholders at the end of the day. However, I think to kind of show you the antithesis, something that I think is not so healthy in this case, is that looking at one of the other Chinese tech companies as well in this mix, which is Baidu. Baidu has recently increased significantly. And for long-time viewers, you probably know that I have a bone to pick with Baidu. I really don't think that it's a healthy company. I don't think it's safe. And I think for investors that are trying to speculate on this name, you probably will make good money in this current momentum run. But for a more long-term sustainable, trying to own this company for the next 5 to 10 years, I definitely do have my own concern here. So free cash flow per share currently went into the negative. Sure, a lot of all these tech companies are currently investing very heavily. They actually have kind of stagnated since 2016. And in fact, just looking at the EPS, similar story for the last 10 years, it basically went nowhere. And in terms of revenue growth rate as well, on top line, they are actually clocking in year-on-year negative growth rates. And no doubt, there are quite a few smart investors trying to make the investment case for Baidu. But to me, at least when I'm weighing the comparisons here, it's not something that I'll go close to. So the consideration here is really to be a lot more aware of the quality of this current rally. And looking at Baidu specifically, this was his investment case. Their core business actually ranks number 5 in China, and they're losing share year after year to every other name in the top 10 names in the advertising industry. So it has been a GDP minus business, and quarter after quarter, the management outlook for this business is monetization is down the road. So is this a quote-unquote value play with a lot of upside momentum? Maybe, maybe not. But I'm more inclined to believe that it's closer to being a value trap rather than a good value stock. Also, in terms of their cloud business, Baidu is not even top 3 in China today. It's probably number 4 or number 5, depending on how you see it. But looking at CapEx, I think Baidu is not getting into the top 3 anytime soon. Is that important? I don't know. But I think the fact of the matter is that their own AI capabilities have failed to improve their core ad business, which kind of shows the limitations of their AI business. And also, in terms of their Apollo and Robotaxi network itself, it's one of 3 or 4 players in China today. And the other 2, which are Pony AI and WeRide, they have not been performing very well as well, which is kind of reflected in their share price. They are also going through a lot of monetization challenges, plus the threat of some of these EV makers trying to push into the space with Huawei, BYD in the whole mix. So really, I do have a very, very negative bias against this company. And my main general takeaway is that I do understand that there are many such examples of extremely low valuation companies that might be net cash. And if you're able to stabilize growth and they can just print that X amount of cash consistently over the next 5 to 10 years, assuming that you have the visibility that they can retain that cash flow, buying it at a 6 to 8 times PE might not necessarily be a very bad idea, given the 10+% yield. But I still believe that the best bet is to stay with quality companies that are still growing and has a proper story to sell and tailwind to sit on. Because I think in this current rally phase, there'll be a lot of so-called rotation and trend following monies trying to speculate and capture the most amount of returns in the shortest period of time, especially if they're cheap and easy to move. And Baidu seems like a good AI alternative in China today compared to Alibaba that has moved quite a bit. Circling back to the idea that since Alibaba has already moved, if you're looking at it from an e-commerce perspective, JD and Pinduoduo is next in line. And if you are looking into the whole AI and cloud play, after Alibaba, in the whole US equity space, Baidu is probably second in line. But going back to my whole case, I do really think that the business looks really big to me. in my humble opinion. So my general takeaway here is that I do believe that it's a little bit too premature to talk about an everything bubble in the Chinese market. But recent stock market movements have indeed been a bit too quick for my own liking for a slow/quiet bull market. So I do expect that the valuation distance from the fear stage to the normal stage gets filled up very quickly in this renewed optimism. And then hopefully there is some sort of a proper price discovery mechanism kicking in as investors express their view on a much more normal level versus the depressed level over the last 4 to 5 years. Instead of this current continuous successive god green candles, which mean that we might potentially deflate very quickly again once the hype is gone. So I do look forward to what you guys think about the current Chinese stock market movements, and I'll see you in the next video, but more importantly and hopefully, I'll see you guys on the moon. Goodbye.